Hello again. I'm back with another video. This time it's going to be a super short one. I'm going to try to keep it under 10 minutes. I'm going to just describe you my model, give it a summary. It will help you and me. For me, it'll be easier to really focus on price action and specifically look for these signatures and kind of like laser in on what I need to be doing, how I need to be executing, and how I need to engage the price. It's basically my ground rules. For you, it's just going to help you. It's going to be a guiding hand in understanding what I'm looking for, and just generally probably going to be making it a little easier for you to follow along. So with that out of the way, let's talk about it. So prior to the beginning of the morning session, which I'm predominantly going to be trading only morning session, 7 a.m. starts off the morning session, New York time, of course. What I do is identify draw on liquidity. Draw on liquidity is where price is likely to move towards. It can be an inefficiency, an imbalance, or an old pool of liquidity on the daily chart. Imagine this is a daily chart that we have here, and we have had an impulsive move lower like that. Um, this impulsive move lower created this little gap here in price. This little gap is called a SIBI. A SIBI is a sell side imbalance, buy side inefficiency. The price was offered so aggressively to the downside that the market actors did not have any ability or opportunity to buy in that market. That basically is the explanation of the second half of the phrase, the buy side inefficiency, sell side imbalance, buy side inefficiency. These sell-side imbalance buy-side inefficiencies, BISIs, I also just call them regularly fair value gaps, FVG, FVG, FVG. Um, they tend to be filled back in. So let's say we are opening and trading right here. To add on to it, let's say we have recently run out a previous sell-side liquidity pool. That just adds on more weight to the argument in favor of filling this gap. So this is basically our higher time frame draw on liquidity. Price is going to want to come back into it. So now, during the first 30 minutes on top of the 7 a.m. hour, this is our 7 a.m. What we do, we search price and we look for relative equal highs and relative equal lows. We have one here, if I can draw it out right there, and we have relative equal highs right there. So this is relative equal highs. I should probably just type it out, it'd be easier. We have relative equal highs, and we have relative equal lows right there. At this point in price, this point in time, we are basically waiting for more information. What I mean by that is we wait until market engineers liquidity in favor of our higher time frame draw on liquidity. And as we said earlier, the higher time frame draw on liquidity is higher, because if you're trading somewhere right here, right there, we would be looking for price to draw higher. We wait. That is basically, if we're bullish, we wait for relative equal highs to be formed, and instead of price going right for them like this, we want to see the opposite movement. So we wanted to see price to go for the relative equal lows and sweep this liquidity pool. We specifically want to see during the first 30 minutes of the hour. And let's say we use the 7 a.m. hour, but we can use 8 a.m. hour, 9 o'clock, and 10 o'clock. And then during the second part of the hour, we're going to be looking for the actual real move to start. This move grants us the understanding that, well, really grants the ability for smart money to order pair right here. What happens in this spot is that anyone who's smart money, who's street money, who's dumb money, who's uninformed, and who's a retail trader, when they see this drop lower, they're likely to act on an impulse and sell into it. They're signing off their own death trap. So them selling into it because old level of support is broken, turns resistance is what they're taught. They sell into it. Them selling is a perfect opportunity for the smart money to pick it up and wait until the real move is going to unfold. So smart money picks it up. Now, at this point in time, once this occurs, we're looking at a heightened probability of original relative equal highs, these ones, to be targeted after the opposing liquidity, the relative equal lows, are swept. We have probabilities on our side because we have a higher time frame drawn liquidity, this one, which is basically transposed in time. Like, let's say it's transposed in lower time frame chart as this little line here, this gap. So we have that on our side. We have the manipulation leg, which has done its damage. We have the opposing liquidity taken out of the marketplace. All of this happens in the first 30 minutes of the hour. And we have relative equal highs remaining up top, clear and smooth and ready to be targeted. Last part of the model is once we have the manipulation move lower against the target relative equal highs, which are in the same direction as the higher time frame draw on liquidity, we then wait for price to move above a short-term high, basically to show willingness it's wanting to move higher. How does it show it? Usually it will move above a short-term high. This is a short-term high, which is basically a 3-candle pattern. It's a little swing high. We want to see price displace above it. Like, imagine you drop something heavy into a little cup, and it's so, like, the pure volume and mass of that object that you drop into the cup, it displaces the water out of the cup. That's displacement. We want to see that because once the algorithm starts spooling in the direction of the draw on liquidity, even though it, like, let's say even if it's a short-term draw on liquidity, like the relative equal highs right here, once the algorithm starts spooling, it just quickly reprices, again creating this imbalance in price. When you roll the paint roller on the wall with the paint really fast, it's not going to deliver the paint onto the wall very efficiently. It's going to leave pores of of the absence of paint on the wall, and those pores, like those porous areas, are going to be wanted to be repriced back into, and that gives us an opportunity to buy. It's going to be scary at first, but once, let's say, this move occurs, we have a shift in market structure to the upside, and then a fair value gap is formed. In this scenario, it would be a BISI, because it would be like reverse of these candles here. It would be one candle like that. Let me just try to draw it out a little. Then one candle like this. Really struggling with pain today, huh? And this would basically be our BISI, buy side imbalance, sell side inefficiency. We then wait for price to trade into it and then go higher. That's basically what I mean. So price trades into it, we buy right here, and then we hold for our relative equal highs or for any reasonable target. Like, for example, if there's an inefficiency right here, we would hold for that, or just hold until my capacity or comfort allows. Like, as soon as I get uncomfortable, I'm just going to close the trade. That's the idea. That's basically a quick summary, 10-minute video reminder what I'm looking for. This requires to recognize the manipulation move and be able to pick up on on liquidity. So, like, we need to be able to see these liquidity pools, and we need to see the inefficiencies in the marketplace. I'm gonna upload my reflection for the past week, the last week that just finished, tomorrow, because I'm a little behind schedule. But yeah, refer to this video. It's going to be super helpful for following the live streams. And actually, I was gonna say I'm gonna do live streams every Monday to Friday. I'm gonna try to keep them probably shorter, so I'm gonna start maybe from 8 a.m. New York time, or maybe even 8:30. Yeah, so we're gonna be practicing this daily, and we're gonna be seeing the results lifetime, like in real time. Anyway, with that, I'm gonna leave you. I gotta go. It's quite late, and I hope you enjoyed this video. I'll see you on the other side.